In the autumn of 2022, roughly $8 billion of customer money simply wasn't where it was supposed to be. Not stolen in a heist, not lost in a crash. Quietly moved and gone. How does a company worth $32 billion disappear in less than 2 weeks? And how did the man behind it convince the smartest investors on Earth to trust him? This is the story of FTX and Sam Bankman-Fried. The rise, the secret pipeline, and the 10 days that ended it all. Sam Bankman-Fried grew up the son of 2 Stanford law professors. He studied physics at MIT, then landed at Jane Street, a secretive trading firm where he learned to spot tiny price gaps and turn them into profit. In 2017, he noticed something strange. Bitcoin traded higher in Japan than in the United States. By buying low and selling high across borders, his new firm, Alameda Research, allegedly moved tens of millions in profit. Alameda was a hedge fund. It traded with its own money and took its own risks. But Sam wanted more. In 2019, he launched FTX, a crypto exchange where ordinary people could buy, sell, and store their coins. Here's the conflict hiding in plain sight. Owning both an exchange that holds customer money and a hedge fund that bets that money creates a temptation as old as banking itself. One side is supposed to be a vault. The other is a casino. FTX grew at staggering speed. It offered slick apps, complex trading tools, and aggressive marketing. Within 2 years, it was handling billions of dollars in trades every single day. The valuation climbed in a vertical line. $1 billion, $10 billion, then $32 billion at its 2022 peak, backed by elite venture funds who barely asked for a board seat. Sam became the face of crypto's respectable future. He testified before Congress, met regulators, and promised to bring rules and safety to a wild industry. He looked like the adult in the room. He cultivated a careful image. Cargo shorts, a rumpled t-shirt, and a beat-up car. He spoke of giving nearly all his fortune away. The message was simple. This billionaire couldn't possibly care about money. You're probably thinking the scruffy look was just personality. But image is a tool. A man who appears indifferent to wealth disarms the very people whose job is to question where the wealth comes from. The marketing machine roared. FTX bought the naming rights to a Miami arena, ran a Super Bowl ad, and signed superstar athletes and celebrities as ambassadors. Trust was being manufactured at industrial scale. Behind the scenes, prosecutors later said, FTX gave Alameda a secret privilege. While other traders had to play by the rules, Alameda could borrow almost without limit and keep a negative balance the system would normally block. Investigators allege that customer deposits flowed straight from FTX into Alameda through a hidden backdoor in the code. Money meant to sit safely in accounts was being used to fund risky bets. Strip away the technology, and this is one of the oldest frauds in finance. Take money people think is safely stored, gamble it elsewhere, and hope you can put it back before anyone asks. Crypto didn't invent this trick, it just hit it better. The borrowed billions funded a spending spree. Venture investments, luxury property in the Bahamas, political donations, and more. Court filings describe over $100 million in Bahamian real estate alone. Where did all the money go? Prosecutors broke it down. Venture bets, real estate, political giving, endorsements, and patching losses. Much of it was spent in ways that could never quickly be turned back into cash. Notice the problem buried in that spending. Customer deposits should always be liquid, available the instant someone wants to withdraw. But the money had been turned into mansions, startups, and influence. The vault was full of promises, not coins. There was another time bomb. A huge slice of Alameda's so-called assets was FTT, a token FTX had created itself. They were using their own homemade currency as collateral for real-world borrowing. Think about how circular that is. FTX printed a token, declared it valuable, then borrowed against it as if it were cash. As long as nobody sold hard, the illusion held. The whole structure depended on confidence. And confidence is fragile. For a while, the music kept playing. Crypto prices were high, withdrawals were smooth, and FTX looked unstoppable. By early 2022, Sam was reportedly worth around $26 billion on paper. When other crypto firms collapsed in mid-2022, Sam played the hero, bailing out rivals with emergency loans. The press called him the lender of last resort, the JP Morgan of crypto. Few realized he was running on borrowed time. In November 2022, a crypto news outlet published a leaked balance sheet for Alameda. It showed the firm's foundation was built largely on FTT, the very token its sister company had invented. The number watchers froze. Days later, the head of rival exchange Binance announced his firm would sell its entire holding of FTT. One tweet. Hundreds of millions in tokens about to hit the market. It was a match dropped on dry grass. The FTT token price began to crater. Sensing danger, customers rushed to pull their money out of FTX all at once. In a single stretch, users tried to withdraw roughly $6 billion in just 72 hours. This is the moment every scheme like this fears: the bank run. A real exchange holding customer coins safely could pay everyone instantly. FTX couldn't, because the coins weren't there. The withdrawals simply stopped. Desperate, Sam looked for a rescuer. Binance signed a non-binding letter to possibly buy FTX. For a few hours, it looked like the empire might be saved at the last second. Then Binance looked at the books. Within a day, it walked away, citing reports of mishandled customer funds and investigations. The lifeline was cut. There was no buyer, no white knight, and no money to give back. By now, the world could see FTX was finished. So here's a question before we go on. When the company filed for bankruptcy, how big do you think the shortfall really was? Take a guess and remember your answer. On November 11, 2022, FTX and around 130 connected companies filed for bankruptcy. Sam resigned as CEO. Just 10 days earlier, the firm had been valued at $32 billion. The restructuring expert brought in to clean up the wreckage had handled Enron. Even he was stunned. He wrote that in his decades of experience, he had never seen such a complete failure of controls and trustworthy records. There was no proper board, no list of who had access to the crypto, and company expenses approved with emoji reactions in a chat app. Billions of dollars had been run like a college group project. This is the red flag that screamed loudest in hindsight. No independent board, no real auditors, no separation between the man and the money. When one person controls everything, there is no one left to say no. The fallout spread fast. Around 1 million creditors were left in limbo. Ordinary customers who had trusted a slick app suddenly couldn't reach savings, paychecks, and life plans locked inside the frozen exchange. On December 12, 2022, Bahamian authorities arrested Sam Bankman-Fried at the request of the United States. He was soon extradited to New York to face a wall of federal charges. Prosecutors charged him with wire fraud, securities fraud, and money laundering. The Securities and Exchange Commission accused him of orchestrating years-long fraud on FTX investors. He pleaded not guilty and prepared to fight. His closest colleagues turned on him. Caroline Ellison, who ran Alameda, and FTX co-founder Gary Wang both pleaded guilty and agreed to cooperate. The people who knew the secret pipeline now described it to a jury. The trial opened in New York in October 2023. Witnesses testified that customer money and Alameda's money were treated as one big pot, and that Sam directed the spending while telling the public funds were safe. On November 2, 2023, after just a few hours of deliberation, the jury reached a verdict: guilty on all 7 counts. In March 2024, a federal judge sentenced Sam Bankman-Fried to 25 years in prison. The court also ordered forfeiture of around $11 billion. The man who looked indifferent to money now owed an almost unimaginable sum. Then came a twist almost no one expected. As crypto prices recovered, the bankruptcy estate recovered enough assets to repay most customers their original dollar value. And in many cases, with interest. Don't let that happy ending fool you. Customers were made mostly whole by a market rally to pure luck, not because the money was ever safe. They were repaid yesterday's dollars while missing years of the rebound they should have owned. So how was this possible? Investors chased hype and skipped due diligence. Regulators were years behind the technology. And a likable founder convinced everyone that rules were for lesser people. Each layer of trust replaced an actual check. The lesson is brutal and simple. If your money is held by a company that also gambles for its own profit, you are not a customer. You are an unsecured lender, whether you know it or not. Separation of funds isn't a detail. It's the whole game. And watch for the pattern, because it repeats. Dazzling growth, a charismatic founder, no independent oversight, and assets you can't easily verify. Those four ingredients have ended more empires than any market crash ever has. FTX once sponsored stadiums and Super Bowl ads, with its logo beamed to millions. Today, that logo is a cautionary symbol, shorthand for how fast manufactured trust can evaporate. The collapse also reshaped the industry. Regulators worldwide pushed for proof of reserves, audits, and clearer rules. The price of FTX's fall was paid partly in stricter scrutiny for everyone who came after. Remember that $8 billion from the very start? The money that simply wasn't where it should have been? It was never lost in a hack or a crash. It was spent, lent, and gambled, hidden behind a friendly face and a clever app. A $32 billion empire died in 10 days. Not because the technology failed, but because the oldest rule in finance was broken. Never gamble with money that isn't yours. If this story gripped you, subscribe for more financial crime documentaries that show you how the money really vanishes.